in listen-only mode.
Ladies and gentlemen, I'm your host, Seth Julian, wishing you all a good evening. Welcoming you to today's short selling and short squeeze session. We're going to talk about how you can sell high and buy low. We'll get into that in a moment. Just like to confirm that you can all hear the audio and see the video, see the opening screen. If you could just acknowledge that by a simple acknowledgement in the question and answer. Just let me know you can see here, and I'll begin straight away. Hey, Pete, good to see you again. Great. All right, ladies and gentlemen, that's going to do. We don't need to see more than one. Got a few coming in. That's fine. Thank you very much. We're going to talk about short selling and short squeezes. This is a subject we've heard a great deal about. Good evening, Sheila. Good to see you today. Hi, Bruce. Hi, Vivian. We're going to, well, let me just introduce myself. My name is Seth Julian. I'm a registered securities dealer out of the Cyprus Securities and Exchange Commission, and therefore have passported dealer registration and authority all over Europe. I'm the chief global strategist here at Alvexo. I've been trading in the capital markets for 51 years now. I'm 64 years old. I started as a young man with a stock trade and have been hooked ever since. I've spent most of my career trading commodities, though I've traded everything else in between, CFDs for FX, in stocks, bonds, indices, and individual stocks, of course, and options. I traded options on stocks for a number of years myself in the early and mid 80s. I started my career out on Wall Street at an outfit called Bankers Trust Company in the early 1980s, and I've been with Alvexo for a number of years here myself. I just want you to know that this is market commentary. You shouldn't conceive this as independent investment research advice. That's given to you by your broker, your personal advisor. We sell contracts for different CFDs to our clients. These are derivative instruments, meaning they're derived from or they're based on the underlying stock or commodity or currency pair. Price movements of the CFD are based on the actual asset price movements and are practically, for all intents and purposes, identical at most any given time. But the client does not assume any ownership on any of the underlying assets traded on CFDs, and that's a huge, huge advantage. And that's why most of the trading that goes on in the world is derivative based. And much of it is CFD based because CFDs are much more flexible, they're cheaper, they're more efficient, they're safer. They allow you to trade in fractional ownership. There are a number of advantages in that, and that's why we trade them. But I do want you to be aware of those realities. Now, what is short selling and short squeezing, which we've heard about? Oh, yes, I do ask you to, and I also might add before we start, this is going to be a fairly short session tonight. This is a remarkably simple yet ill understood subject. But once we expose it to you, I believe that you'll be able to grasp it quite simply and does not take a lot of mathematics or even complex note taking. It's a fairly straightforward proposition. But yes, so buy low and sell high. This is a widely understood, widely practiced for opportunities worldwide for eons. It's referred to as being long or buying or bidding. All of those terms refer to buying something with the intent of selling it at a higher price. And it's often known to laymen in the housing market, buying properties and flipping them is a common among people of that ilk. They buy properties and simply turn them around quickly for a quick profit, which, by the way, we do in speculating in capital assets. It's no difference, except that the assets themselves are highly different. But the idea of buying an asset for profit by selling it at more than you purchased it for is intuitive. It's basic. We all understand that. You buy the ingredients for the lemonade, you mix them all up, you set up a little stand, and you sell it for more than the ingredients cost, i.e. the profit. Now, think of longs, people who are long something or owning something, as owners expecting prices to rise, later selling their asset for more than they paid. And even retailers like the lemonade stand salesman, he's long or she's long the lemonade. They buy the goods. They They buy the goods and then they sell them for more than they paid for them. Should prices for those goods fall, the long retailer may sell the inventory at a lower price. He'll short or sell the inventory. Now, the shorting of the previous long positions closes the transaction, referred to as a round trip by commodity traders and brokers. Let me explain this a little more clearly because, frankly, this text is not so good. We can sell before we buy. In other words, it's the inverse of the old adage of buy low, sell high. You sell high and buy low. Now, here's where some of the confusion comes in for a lot of new traders. It's barely understood. It's rarely practiced even by other than financially savvy speculators. But this practice of short selling often provides outstanding and outsized opportunities, particularly when prices are falling. And without using this tool, we miss out on about half of all the opportunities in a given trading market. And depending on the market circumstance, we can be passing up much more than half. For example, since the pandemic, those of you who have been trading since Q2 of 2020 will well understand that markets fell precipitously, and there were tremendous profits to be made, tremendous profits by selling short. How does that work? Well, the democratization of financial market trading made this very valuable practice available to every trader for many, many eons, really. This possibility was only available to the very biggest accounts. Why? Because in the days before we had as many derivatives as we had, you actually had to borrow the shares, if we're talking about shares, or actually any asset for that matter. No, that's not true. Commodities are different in that sense, but I'll leave commodities out for the moment. Talking about shares, you had to borrow physically those shares from someone who was willing to lend them. And the lender of those shares made a small profit, whether the price went up or down, and that was part of your expense in selling short. And the ability to borrow them required a certain margin, just like it does opening any trade. But because you were opening a trade with borrowed assets, you had to pay more for that opportunity. This was not available to the retail trader like you and me. However, the democratization of this process by opening up markets to ordinary traders through vehicles like the contract for difference and different options and different opportunities for small-time traders to trade, we can sell short just like the big traders can. So, counterintuitive as sell high, buy low strategy may be, as traders who are aware and conscious of what the market's doing and are trying to take a little money out of the market to their advantage, we have to understand this phenomena to profit by practicing it. So, any questions, ladies and gentlemen, so far? I realize that while utterly simple, it's not intuitive and therefore not necessarily easily understood at first glance. So please feel free to ask any questions you may have. We fully respect the questioning act. It's a sign of commitment, and there are no questions that I don't want anybody to feel inhibited or intimidated in any way by asking them. We don't have any derisive or derisory responses to them. We try to answer them as honestly and open as we can. If they're not germane, of course, we'll set them up. We'll answer them later offline. Now, assume for a moment that you can sell an asset before buying it for a price, and then when you acquire it, when acquiring it, to close the transaction following your sale, you now buy it at less than you sold it for. Okay? So in all transactions, when you open the position, generally you buy, and when you close this position, you sell. And you know that, from executing ordinary trades on the platform, it says buy, and then when you say exit position, it says close, you sell it. That's obvious. What's less obvious is the opposite. You will enter a position by selling it, and then in order to close the position, you buy it. It's that simple, ladies and gentlemen. And the only thing that you have to understand is that you sold it for 10, and then when you buy it back to close the position, you buy it for 8. So you sold it for 10. In other words, it went down in price, and when you close it, you're buying it for less than you sold it. That's your profit. Just like when you buy something and then sell it, it goes up. This time you sell it, and as it goes down, you buy it back for less. That difference in what you sold it for, what you received 10 for it when you sold it, and then when you close the position to buy it back to close, you only have to pay 8 because the price fell. That's your profit. Just like buying low at 8 and selling it for 10 is your profit on the upside. Clear, ladies and gentlemen? Good. Okay, I don't see any questions, so I'm going to assume that I can proceed. So again, think about it for a moment. It's the same proposition as buying for a price and selling at a higher price, but in the downward price direction. So how can you sell something before buying it? You borrow it from someone who has it to lend. How does this work? In the derivatives market, which is what we operate in, as I mentioned at the outset, the process of short selling before buying it is highly efficient, meaning that it's possible to sell short without any loan of assets. This is one of the many, many great advantages of dealing in the derivatives world. It's much, much more flexible. You don't actually have to physically borrow anything. These are derivatives and hence notional assets. They're just created based on price. They're derived from the actual. They aren't the actual. Just as I said in the opening statement, this is one of the tremendous advantages of the derivative world. So all you have to do, it's just as simple as I explained it. You hit sell first. As the price falls, when you made your profit, you say buy, and then you buy it back for less than you sold it for. The difference between what you received when you sold it at the opening of the position and what you pay to buy it back to close the position is your profit if the price went down. Ladies and gentlemen, that's all there is to it. So I want to talk a little bit about short squeezing. What does that mean? We've heard a lot about that, particularly the GameStop phenomena and the meme stocks, which is an annoying term. By the way, I have to tell you, I don't like jargon at all. I'm too old to really appreciate the hipness of it. I, in fact, take it as a personal annoyance and insult when jargon is used because it's clear to me that it's being used to confuse me. And my feeling is, certainly in my profession, if I don't understand something, it's because whoever is speaking to me or explaining it to me doesn't want me to understand. That annoys me. So unfortunately, we have to contend with this because, like every business, although I must be frank and say that the finance and economics business excels at this more than maybe medicine, or medicine speaks in Greek and Latin, of course. But I don't know. As I grow older, I'm getting more annoyed with the jargon and the use of terminology that's clearly designed for me to be confused. That's what they want. It lends a sense of expertise and knowledgeability to people who use this. I think that's bullshit myself, and I really don't appreciate it. So I'm going to try and burst some of those annoying pains that are created from this. So for example, like the meme stocks. What the hell is a meme stock? It means just something that's got a buzz, something that's popular at the moment. But instead of that, we give it a name so as to make the phenomena sound exclusive. Anyway, what is this is really the GameStop story. And also and this will go into detail about, will the recording and slides be available after the session, please, asks Carmen. Indeed, they are. We're recording now, Carmen. And shortly after the session closes, a couple hours actually, because it takes time to process, you will receive a link to the recording and you can listen to it at your leisure. So how do you take advantage from these short squeezes? First, let's be clear on what a point is. There's no definite strategy on how to, quote, profit from a squeeze. There's not one in the case of there is not one also in the case of a corner, a market corner, which is even rarer than a squeeze. Excuse me. These are very rare events, and they're always fraught with tension, uncertainty, and usually unbearably high stakes. But let's go into it, at least for the moment, so we understand the terminology. In the case of GameStop, you will recall that when the pandemic broke out and consumers were locked into their homes, they were instructed straight away to stay home, don't go to work. The first time in all of recorded economic history that governments actually required, not only suggested, but required that their workforce not go to work. People had a lot of time on their hands. And thanks to, again, that democratization of capital markets, people without huge fortunes and large trading accounts could easily trade in all sorts of stocks, commodities, all sorts of stuff. And one of the phenomena we saw was a stock called GameStop, which, for those of you who are aware, and I frankly was not aware of this other than to look at the charts, but of course I did a little research and found out GameStop was a chain of stores all over the United States that sold video games. And for a certain niche of the population, not a small one, I might add, they were immensely popular, like the old Radio Shacks were, to those of you who might be familiar with those, or any sort of, it's just, an older retailer outlet that wasn't very popular but among the general population, but very beloved among a specific sector of the population. Now, the stock had been underperforming for a long time, and a lot of the big traders, hedge funders, had been selling it short, as we had explained earlier. They were short, and they were profiting from the decline in value of the stock. Now, this phenomena, frankly, annoyed a great many of the fans of the stock. And you might be able to see why. Hard to understand. Something you really enjoy, something you like, something you patronize, that's not making a profit as far as a stock investment is concerned, and therefore serving the profits of those people who want to see it decline, is surely an annoyance. You can understand that. And those people who were annoyed started to buy the stock up. So much so that all of the people who were short the stock were squeezed. In other words, they're shorting the stock, and as the stock direction goes against their short positions, they're losing money. That loss is called a squeeze, and therefore, when the market consciously buys against people who are holding short positions, that conscious maneuver is called a short squeeze, because the short positions are squeezed. Fairly straightforward, not too terribly jargonesque. I was referring more to that term meme stock, which I found annoying at the time. But the short squeeze has been around for forever. And I just, a brief moment here, back in the late 1970s, early 1980s, when the Hunt brothers, those of you who might recall have been trading in the markets for a long time like I have, recall the Hunt brothers silver corner. A corner is actually when stocks are, or the stock, or the quantity of the asset is so concentrated in the hands of one or a very, very few small number of traders that they actually could dominate the market. They dominate the market for a certain asset, and that domination is called a corner. That I can't explain why, but they corner the market. They squeeze out all the other players, or many of the other players, making it very hard for them to acquire the asset because they control so much of it. They drive the price up artificially. Again, with concept, that's the reality of the corner. It's not because it's a very, very risky situation. Best not even approach. In the case of the short squeezing, again, that is also a risky product. I have to confess, in the interest of full disclosure, I did make a little bit of money when GameStop had risen to unbelievable prices. I got in like I sold it short around 120 as it started to come down. You know, I was not involved here, but I started to follow what was going on, and even at around the 120 level, I knew that it was really overvalued, and made a little money on the selling it short actually. But I didn't get involved in anything like this. This was only for people with much stronger stomach linings than I have. And certainly in the case of the squeezes, I watched this as a young trader, but I knew better than to get involved. The Hunt brothers, by the way, Nelson and Bunker Hunt, were huge industrialists with very deep pockets, and we're obviously not someone a young trader like myself wanted to be trading against or even with. So corners are very rare now, particularly since the democratization of these markets. I haven't seen a corner, frankly, since the Hunt brothers attempted to corner the silver market back in the late 1970s. But that's what short squeezing is, and that's what market corners are. But I just want to make sure that everybody understands what the short, how to short assets and how to trade them short. And let's go to the to the platform and just take a short position just to show you how utterly simple it really is. And let's open the floor to any questions if you have any while I'm changing screens. Any questions, ladies and gentlemen? Okay, let me just move screens around here, and we will take a look at. Well, we'll do a little shopping before we start trading. We'll see what's what. Let me reopen the screens. We're now looking at the 10-year note. By the way, this long stem here and this huge volume that took place a mere what are these a couple of hours ago was when the Federal Reserve announced that it was raising interest rate by 0.5 percentage point, 50 basis points, double what the expectation, or at least the widely held expectation. There were others who felt it would jump up by 0.5%. It really took a dip down, but immediately returned. And I won't go into the arcane nature of the bond markets, but certainly the decline was expected. The question is this going to decline anymore? My feeling is it will, and to bear that out, let's just take a longer view. We'll take a daily chart. This is the longer view of the U.S. 10-year note. And the reason for this decline, as it has been doing, and so I don't know, I guess I could tell you, exactly, since August of 20, right after his, here's the big, where's the pandemic? Here's the pandemic moving in here. This is tremendously because the market is tanking and it's a safe asset. And then as boom, the bond market becomes less attractive, and then as the stock market starts to really sell off and inflation takes hold because the supply lines are getting shorter and tangled and screwed up, inflation starts to hit and bonds lose their appeal. And this, of course, these last few days, the chart is the outbreak of hostilities in Eastern Europe. So we think it's going to continue. Again, a daily chart, that's just a little blip. We think it's going to continue. So let's, just for the sake of practice, let's take a short position on the US 10-year note. We'll go to the platform and we'll find bonds. We sell two bond products here. And one is the European 10-year bond, and one is the why is this? What happened to bonds? Here we go. All bonds too. And we'll take the US 10-year. We're going to sell the US 10-year. All we're doing is entering the sell position before the buy. It's this simple, ladies and gentlemen. We sell it $1,400. That's a nice size lot. It's a little over one bond position. I'll dispense with taking profits and losses at the moment, just for ease of execution. Notice, by selling. Action completed. I've got the fill on the bond sale. All there is to it. Take a look. We'll go back to the, and we think that it's going to fall back from here. That's all there is to it. When I go to close the position, all I have to do is buy it back at the lower price than what I sold it for. Remember, I sold it at, and when I buy it back, it will hopefully be, say, 123.50, 123. That difference is my profit. Any questions at all, ladies and gentlemen? All right, then. If there are no more questions, and Pete, how is the sound? Is it still breaking up? Is it still poor? I'm sorry for that. I haven't had this problem for some time. All right, then, ladies and gentlemen. In the event that it doesn't matter, it's too late. I'm ending the session now anyway. But Pete, just tell me if the sound. He says it's okay now. All right, good. Sometimes I just edit and speak too loudly into the mic. That's also a possibility. Anyway, ladies and gentlemen, let me end with a few summary notes. First of all, short selling is, as you can see, utterly simple. A crucial device used when prices are falling. And prices fall on average as often as they do, as often as they rise. However, I want to point out, when they fall much more sharply than when they rise. And so the opportunities are greater. When you take a short position, you can often make way more in the same period of time than you could in a long position, because they fall more quickly than they rise. And that's due to the psychology of markets, which is, well, I'm not going to go into the psychology of markets. Suffice to say, if you do a little research, you'll see that the declines are usually sharper and faster than the rises. The next thing I want to point out to you is that if you're, certainly our clients are well aware of the kinds of products and services that we offer them, these sessions including, but if you're shopping for an online broker, please consider opening an account with us here at Alvexo. We do our best for our clients. We offer you the widest range of services and tools, particularly for newcomers and neophytes to the business. We're stand-up, honest, straight-up brokers that do the best we can for our clients. We're not always right. We lose money, okay? Let's get that out of the way. We lose money like everybody else loses money, but the sine qua non in this business is making more money than you lose. And over the long run, we are good at that, and we do that, and we help you do that too. It takes practice. It takes time. This is not, contrary to the nonsense that's often proffered on the internet, this is not a get-rich-quick scheme. This is a real business that takes real effort and real work and real research and real commitment. But it's also one of the most lucrative businesses for people without a great deal of capital that exist on Earth. And that's why it's very attractive to so many people. So, ladies and gentlemen, with that, I'm going to bid you adieu. Thank you all for joining, and I wish you all, ladies and gentlemen, the ability to trade with confidence. Yes, I'll catch you next time, Pete. Thank you for joining us, and thank you for your input. Please welcome, and thank you all for participating. It's a pleasure to be here, and we'll see you again. We'll see you again soon. Watch for the announcements. Watch for the next sessions, and we wish you all, gentlemen, the ability to trade with confidence. Bye-bye, Silo. Thank you all.